Hello there. Welcome to Grade Core of Accounting. We have got a question that we have here from June 2023. The question is on statement of comprehensive income and statement of financial position. And the question reads, the information relates to Midrose Limited for the financial year ended on 28th February 2023. Then on the required part, 1.1 is saying refer to information B1 and 2 calculate. We are given there on 1.1. When we go to 1.1.1, is saying is asking on the calculation of the profit or loss on the trade-in of the old vehicle. 1.1.2 is the total depreciation for the year, and if you go to 1.2, it's saying complete the following for the year ended 28th February 2023. Then the first part needs statement of comprehensive income or the income statement. You go down, you got 1.2.2. It requires us equity and liability section of the statement of financial position or the balance sheet. So these are the requirements on this question. But if you go up there at the beginning of the question, we are being given a hint in terms of the period or the time that we are supposed to spend on this question. We have got 45 minutes that are required for us to spend on this question one. And also, this question has got 60 marks. Very important to take note because it contains the bulk of the marks of this paper one, question paper. So let's be careful and abide by the time limit that we have there so that we don't waste time. Right, let's go to our question. Let's go with the first part of the question, which requires us to calculate the profits or loss on the trade-in of the vehicle. Remember, when there's a trade-in, we are buying another non-current asset, and we issue out another old non-current asset that we are having in the business as part payment of that asset that we are buying. So that basically is our trade-in. So this trade-in now, we need to calculate its profit or loss on disposal because we are in the books of accounts. We are going to treat it as if we have disposed it. Remember, when we sell a non-current asset, we have to prepare a disposal account so that we see whether we made a profit or loss on that non-current asset account. Right. So if you go to our question now, information that we are given, let's try to see. This is the information that we have in the question. So we want to see what happened on that trade-in, on the trade-in non-current assets. So on part one, that's where we have the information in saying the following transaction was not recorded, and all the vehicle cost price 270,000 was traded in on 28 February 2023 for a newer model which costs 616,500. The accumulated depreciation on the trade-in date was 111,240. The trade-in value for the old vehicle was 105,000. So, and then the question goes on and say depreciation on vehicles is calculated at 10% per annum on the diminishing balance method. So, very important to take note of the method of calculation of depreciation there, which is diminishing balance. So the trade-in that we have there, if you go to the question, the trade-in that we have there, you had a cost price of 270. Very important to take note. And then the value that it was traded in for, it's here. The trade-in value for the old vehicle was 105,000. So very important to take note. So for us to simplify this calculation, we know when you open our disposal account, when you open our disposal account, we have our disposal account like this. This is our disposal account. Our disposal account of any non-current asset, the cost price price of that non-current asset that we have disposed, we put it on the debit side. Then the accumulated depreciation to date, the accumulated depreciation up to the date that we have disposed that non-current asset comes on the credit side, and the amount that we have we have disposed that non-current asset also will come on the credit side as cash or bank, depending on the method of payment, cash or bank. Or if it's on credit, we also put the name of the creditor there. Because if there's no cash or a bank that has been received, it's on credit. It means we don't have to put cash or bank there. We put the name of the person or company that we've sold to, right? That is the scenario that we have there. So in our question also, we would want to also to see how we are going to present that. So if you go to this note, it's saying the cost is 270,000 here, 270, and it was disposed for trading value of 105. So it means this is the value that it was traded in for. So it's going to the credit side. Then this cost price comes to the debit side. Then the accumulated depreciation again on the date of disposal is given there. This is the 105,000 is the trade-in value, 105,000. Then the accumulated depreciation on the trade-in date was 111,240. So this one will come to the credit. This 111,240 will come to the credit like what we presented there. And this one, this is the value of trading, also credit. And this one is going to come to the debit. Then we compare the two sides to see if it's a profit or loss on disposal. So we go back to that T account that we prepared there, and we are going to see that our 270 is the cost. That's the one that is supposed to come on the debit side. So 270 there. We have 270,000 on the debit, and then the other amount, the trading value is 105,000 on the credit, and then we have also the accumulated depreciation up to date, which is 111,240. So if you add the credit and the debit, you are going to see that the debit total for the debit is going to be a greater size, and we want to see with how much. So if you add the debit there, the debit side, you say 105,000. You add the 111,240. You are supposed to get 111,240. You are supposed to get 216,240. 216,240. And you see that this is a lesser total than 270 that we have on the credit. So it means our balance is going to come here. So when it's coming here, it means we are crediting the disposal accounts, and then the next entry is that we, in terms of double entry, we are going to debit the profit and loss account. And when you debit the profit and loss account, remember on the profit and loss account, profit and loss, we have got expenses on the debit, and then we've got income on the credit. So when we debit the profit and loss, it means it's a loss. So here it's a loss because this, the credit side has got a smaller figure. So we are going to summarize our working in the answer section by saying 270 minus 105,000 minus 111,240 to get the balance, which is our X here. So we go to our answer section. Our answer section, we are on the answer section now. Then we summarize that working now. We are now going to say 270,000. 270,000. Then we will subtract 111,000. We subtract 111,240. And then we subtract 105,000. So when you do that correctly, you're supposed to get 53,760. So that's what we have on the first part. Then the second part, we are here now. We want the total depreciation for the year. The total depreciation for the year. So we are going back again and try to find the total depreciation for the year. we go to the information that we have there in the question. And remember, let's take note here on the trade in. The date that this old vehicle was disposed is on 28 February 2023. And remember, 28 February 2023 is the date of the end of the year. It means this old vehicle stayed in the business for the whole year. Because if you come here, you'd find that the year ends the year ended 28 February 2023, and that's when the old vehicle was sold. So it means for that year it stayed the whole year. So you're going to charge depreciation for that old vehicle for the whole year. So we are not going to apportion in terms of the number of months that it stayed, because it stayed 12 months. So we are just going to calculate as normal there. If you go all the balances that we are given there, we are going to calculate the depreciation. We have got the equipment as a non-current asset, and also vehicles as the non-current asset. So let's start by vehicles. We have the costs of at the beginning, the cost is 1,350,000, and then for accumulated depreciation for vehicles at the beginning is 855,000. So would one now to see what method of calculating are we using for vehicles? We go down. We come here, depreciation on vehicles is calculated 20% per annum on the diminishing balance method. So 20% on the diminishing balance method. And we know when we're using the diminishing balance method, the formula that we use there is percentage times the carrying value, where the carrying value is equals to costs minus accumulated depreciation. So in this case, we have to first find the carrying value. Our cost we said is 1,350,000. 1,350,000. Then we subtract the accumulated depreciation that we are given in the year is 855. So when you find that figure, when you calculate that 1,350,000 minus 855, let's try to calculate that one so that we see what we are supposed to get there. We get 495,000. So here we get 495,000. So 495,000 is our carrying value. So our depreciation is 20%. So you're going to say 0.2 times the carrying value, which is 495,000. Right. So this one is for vehicles. So when you do that, when you calculate that one for vehicles, you are supposed to get 99,000. So you get 99 here. So that is for vehicles, but we still have equipment there. We still have equipment there. And if you look at equipment, we are given the equipment costs at the beginning and at the end, and also we are given accumulated depreciation on equipment at the beginning and at the end. And then we now want to see the what are they saying about the calculation of that depreciation on equipment. We come here on 2. They are saying depreciation on equipment was brought into account. We are not told. The question is silent in terms of equipment that was disposed or that was purchased. So it means we didn't have any of the equipment that was coming in the business or going out of the business. So we are just going to see the difference of the accumulated depreciation that we have there in the list of balances, and then we find the figure for depreciation for equipment, because we didn't have any adjustment in terms of purchase of equipment or disposal of equipment. So basically what we are going to do, we are going to see the difference. This is accumulated depreciation for equipment at the beginning, and this one is at the end. So to find the depreciation for the end now, we are just simply going to say 800,000, 900, and then we subtract, the other way around. We are going to say, we are going just going to make it the other way around, because this one is the end of the year. The end of the year, we had 923 after adding depreciation for the year. So this one, 920,260 is accumulated depreciation at the beginning plus depreciation for the year. We get this one. So we want now to find the depreciation for the year. So basically what we are saying 800, 900, 800,000, 900 plus X, which is the accumulated for the depreciation for the year. You get the, sorry, X is the depreciation for the year. We get the accumulated depreciation at the end of the year, which is 923,260. So to get X, we make it subject to the formula. Then we are going to just get the difference of the two there. So here we are going to say we are going to say 923 923,800. According to the figures that we have there, it's 923,260. Then we subtract 800,900. Then we get the depreciation for the year. So that's the calculation that we are supposed to make there. So when you do that, when you say 920,260 minus 800,900, you are supposed to get 122,360. So this is the depreciation for equipment, and also we have depreciation for motor vehicles, which is 99,000. So we are going to add this one, 122,360, then we add 99,000 to get the total. So we are just going to summarize that on the answer section there. Right, for depreciation, we come here now and we say, we just make a summary. Maybe you can show that for how you found the depreciation for vehicles. Okay, it's given there for equipment. We start with equipment there. For equipment, on how we find for equipment, we said 923,260. Then we subtracted 800,900. Then we got the figure that we got for equipment was 122,360. Then we also summarize the working for depreciation on vehicles. Remember, we first found the carrying value, and then we multiply by 0.2. So we are just going to summarize the working by saying 0.2 is the 20%. Then we multiply by the difference that we have for costs, which is 1,350,000. 1,350,000 minus 855,000. And you can simplify it further by saying 0.2 times the difference between these two is 495. So when you calculate there, you get 99,000. So then when you add the two now, 122,360 plus 99,000, you are supposed to get 221,360. Right, so that's the total depreciation that we have there. Then we move on to the next question. Right, we move on to the next question. If you go back to to the beginning of the question, you would see that our next item after total depreciation for the year is the statement of comprehensive income. We are now on 1.2.1, and we are still, the year end is still the same, it's 20th February 2023. So our statement of comprehensive income, we have it there in terms of the answer book, what we are given in the answer book. If you go there, that is our statement of comprehensive income. We've got sales, cost of sales, gross profit, then other income. Then we take note that we've got a figure that is pre-entered for discount received, 32,400. So we are going to start on sales. So what we are going to do is we are going to check the figure for sales that we are given in the list of balances. Then when we check that figure, we check on additional information if you get anything that is going to affect our sales. If there's anything, we have to adjust that. If you come here, you would see that the figure for we are given the figure for net sales, which is 11,734,000. So that's the figure that we have. So we check if you've got anything that is affecting sales. If you don't have, we put the 11,724,000. So let's go down and try to check what we have on additional information. Already we know that on 1 is something to do with depreciation. We leave that. We go again, 2 is depreciation. We go to 3. We are now on this one, 3. And let's see what 3 is saying. We are now on 3, and 3 is saying an invoice of 28,800 issued to a debtor for goods purchased on 26 February 2023 was incorrectly recorded as a credit note. The markup on these goods were 60%. So what happens, a credit note is issued when there are sales returns. So when there are sales returns, the sales figure is going to be reduced. So what it means here is that this 28,800 was supposed to add to sales, but it was subtracted to sales. So what do we have to do? To correct this error, we have to add the 28,800 first to remove that one that was subtracted. And when we add this 28,800, it comes back to 0. Remember, there's a negative 28,800 that is there. That was not supposed to be there. So we are going to add this one first, and then we enter the actual that was supposed to be entered. We enter again another plus 28,800. So we have got a double 28,800 that we are going to correct on sales to add to sales. So when you say 28,800 plus 28,800, you are going to get 57,600. So this is the figure that we want to add to the figure of sales that we are given. And we also check if you've got any other entry again that is affecting sales. We go to 4, amount of 3,232 was not received from the insolvent estate of a debtor must be written off. This is not going to affect the sales figure. This is paid debts. So we leave it. Then we've got the issue of provision for paid debts must be decreased by 2,000. It's not going to affect. Remember, when there's a decrease in provision for doubtful debts, this is going to be income. So it's not going to affect. Then we go to the next page. We have got on this one is talking about rent increase. It's not going to affect again sales. So it means this is the information only that we have for that is affecting sales. This one for item 3. So we are going to add 57,600 on the part of sales. So the figure for sales, we are given in the list of balances. We go there, the net sales is 11,724,000. It's here, 11,724,000. So that's the figure that we are going to enter there. So we go to the answer section. If we go to the answer section now, we are going to say, here we summarize the working, we say 11,724,000. Then we add the 57,600. When you do this, you're supposed to get 11,781,600. Right. So when these goods were retained again, when they were treated as returns, it means they went again and increased the figure for inventory. Remember, we have got stock in the trading account. For the calculation of cost of sales, we say opening stock, we add purchases, we less closing stock. So the figure for closing stock increased as we treated them as returns. They reduced sales as returns, and then they also increased the figure for sales. So we need to correct that again because these were sales. We need to correct again and remove those goods from the closing stock. So by removing it means we are going to reduce the figure for closing stock. And when you reduce the figure for closing stock, it means the figure for cost of sales also is going to increase. Remember, this was supposed to be the invoice, so these goods were going out. So we need to also, in addition of that cost of sales of those goods. So what we are going to do is we are also going to adjust for cost of sales. But if you go to the question, that 28,800 was a figure with a markup inside. So we need to find out the cost price of those goods so that we adjust in the closing stock, right? And they're going to affect the cost of sales, right? If you go there on that part again, we go back on that part. That is on item 2. So we go to item 3 there, right? The statement is saying an invoice of credit 800 issued to a data for goods purchased on period February 2023 was incorrectly recorded as a credit note. So these goods, we need to find the cost price of these goods. So to find the cost price of these goods, we are going to say we are told that the markup is 60%. So the issue is we have 100% as the cost price, then we add the markup 60%, then you get the selling price, which is 160. So this is the cost price. And this is the markup. We add the markup here, and we get the selling price. So the issue that we have here is that we want the value of the cost price, and what we know is we are given the figure for selling price, which is 160. So basically, we are just going to make a proportion there by saying 160 is equals to 28,800. So the figure that we want is 100%. So we don't know this figure. That's the figure that we want. So basically, you come this side that we have and the figure that we are given is 460, and we want 100. 100 is a smaller figure. So the figure that we want here is a question mark, is a smaller figure. So if it's a smaller figure, it means this side, we put the smaller figure as the numerator. So the smaller figure is 100, you put it as a numerator. Then the other figure becomes the denominator. Then you multiply by the given figure, which is 28,800 over 1 to get the cost price. So if you do that, if you multiply it like that, you are supposed to get 36,000. So that 36,000 is going to reduce the figure for closing stock. And when the figure for closing stock is reduced, it means our cost of sales are increased. So we are going to add the figure that we got for 36,000. So we are saying if you multiply here, you get, here we are saying 100 over 160 plus times, we are not going to multiply by 28,800 because this, remember, we are going to have a double effect, which is 57,600. So we are going to multiply by 57,600 as the selling price that we have, which is the 160%. What we are saying is this, we are going to have a double effect. So the double effect on the sales we had 57,600. So the double effect also is going to we are going to have it here on the cost of sales. But basically, alternatively, you can just say 100 over 60 times 28,800, and when you do this, you get 18,000. But this 18,000, you then multiply it by 2. You then multiply it by 2 because it's a double effect, and you get 36,000. Or we can just say 100 over 160 times 57,600. Then you get 36,000. So this 36,000 is the one that is going to increase the cost of sales. So if you go back there on our answer book, we are now summarizing that working. So the cost of sales that we are given in the question is 7,327,500. Then we add the 36,000 that we have there. Then when we do that, we get 7,363,000. 7,363,500. So this is our cost of sales, and we subtract cost of sales from sales to get our gross profit. So when you subtract the two, you're supposed to get 4,418,100. That's the figure that we are supposed to get there. Then you go to the other income section. So the amount received is already entered. Then we are going to look for other income that we have in the question. So if you go back to the question there, we go back to the list of balance that we are given to check what other income do we have in the question. Right. If you start from the top there, we go down trying to look for income that we have in the question. Of course, we have got provision for bad debts, but we are already told that this provision is a decrease, and we know that if it's a decrease, it's income. But when it's an increase, that's when it becomes an expense. So if you come here, we are told that on 5, the provision for bad debts must be decreased by 2,000. So this 2,000 is income. So we are going to put that one as provision for bad debts adjustment. So we go to the other income section. Then we say provision for bad debts adjustment. Provision for bad debts adjustment. And we are told that it's 2,000. So we are going to put the 2,000 there. Then we go back again to check any other income that we have in the question. Right. In the question, we go up again in the list of balances. Check other income there. We're on provision for bad debts there. We go down again. We source income checks, mortgage loan, retained income, here, salaries and wages, all these expenses, employers' contributions, directors' fees. Then we have got rent income now. We have got rent income. So we check again in terms of rent income. We have this rent income 174,675. So what we do is we check in the additional information if you've got anything that is affecting rent income, and we adjust for that. If you don't have anything that is affecting rent income, we just put this 174,675 as it is in the statement of comprehensive income under other income. So we go down to check any adjustment that we have that is explaining about rent income. You see here, we don't have, move through the information that we have here, we don't have anything affecting rent income. So we go to the next page. Right, we go there, we have got something that is affecting rent income on 5 here. We are told that rent increased by 10% per month with effect from 1 September 2022. As per the lease agreement, rent is received until March 2023. So let's try to see what is transpired there. But what we are told is that the rent increase, we increased by 10% per month with effect from 1 September. And we know that our year is starting on 1 March 2022. And then it's ending on 28th February 2023. Very important to take note of that. So what it means is the rent is being explained as to have increased on 1 September. So let's see how many months were there before it increased. So from 20th February, we have March, the month of March, and then we've got the month of April, May, June, July, August. So these months, the rent had not yet increased. So how many months do we have there? 1, 2, 3, 4, 5, 6. So we have got 6 months. So let's take the monthly rate as X. Before it increased, it was X. So we just say so the rent that was paid that was received before the increase was 6X. And then we try to look after it increased, how many months do we have up to the end of the year. So it effect from 1 September, it means it increased in September, October, November, December, January, February. And then we also received for March. So we've got also March inside that. So we count how many months do we have there? 1, 2, 3, 4, 5, 6, 7. So we've got 7 months. So if you add now the 7 months, but on the 7 months, it had increased by 10%. So we are going to say 10%, 10%. Here we've got 7 months. Then the 10% is obviously we had 100% before it increased. Then plus the 10% that it increased with, we get 110%. So as a decimal, 110% is what? Is 1.1. If you divide 110 by 100, 100 into 110, you get 1.1. So this is the after it had increased. So if you multiply these 7 months by 1.1x, as we are saying, x is representing our monthly rental before it increased. So if you do that, you get the total that is given, that was received for the year. And if you go back to check that total that was received for the year in the list of balances, let's check the amount that was received for the year. We are being told that the rent that was received 174,675. So that equation should be equal to 174,675. 174,675. Right. We are going to say 174 here. 675. Then we can try to solve that equation so that we find the value for x. Because what is happening is the rent for March is the rent that we want to remove from total rent that we are given from this 174,674. Was for March it was a prepayment, and remember a prepayment, we remove it according to the matching concept, we remove it in the current period because it doesn't belong to this period. So this is the rent that we want to try to find out. And this rent, according to the information that we have, it means that this rent is 1.1x, of which x is the monthly rent that we had before the increment. So if we solve this equation, we are going to have 6x plus, if multiply 7 by 1.1x, we get 7.7x is equal to 174,675. You get 174,675. And then if you add 6x plus 7.7x, you get 18.7x equal to 174,675. Then you now divide by 13.7 both sides. If you do that, let's try to calculate that one. If you divide there, you are supposed to get 12,750. 12,750. So it means 12,750 was the rent before it increased by 10%. So, but on the March that you want to receive, the rent for March that you want to receive, it had increased by 10%. So it means we are just going to say 12,750 times 1.1 to get that after the increment. So if you do that now, you get 14,025. So this is the rent for March. So we need to subtract it. So we're going to say 174,675. We subtract this 14,025 that was prepaid. So we go to the question. We go to the question and summarize that one for rent. So it means here we have rent income. So here we have got our rent income. we have our rent income. Then in brackets, we just summarize the working, which is 174,675. Then you subtract the 14,025 that we calculated for March, and then you get 160,650. Right, so that's what we have there in terms of rent. Then we go back again to the question and try to see if we have got any other income that we have in the list of balances. Right. After rent income, we've got bad debts, which is an expense, then sundry expenses. All of them are expense. So it means we've exhausted all the income that we have in the question, and then we go there and try to add the total for income there. So we are going to say 32,400. We add 2,000. We add 160,650. The total that we are supposed to get there is 195, 195,055. So remember here, what we do is we say gross profits, we add other income to get the total for gross operating income here. So if we say 4,418,100 plus 100 plus 195,055, you are supposed to get 4 million. If we add the two there, let's try to find out. Let's try to add and find the actual total that we get there. We add the two there, then we get right. So the total that you get for gross operating income there is 4,613,150. So that's the figure that we have for gross operating income. Then we go to operating expenses. Now for operating expenses, we leave it as we try to find the total by listing all the operating expenses that we have beneath that. Right, we have got all the fees pre-entered and then insurance pre-entered. So we are going to look for other operating expenses that are there in the question that are not these two. So let's go to the list of balances. The list of balances we have right. Remember we have those two that are pre-entered. We have those two that are pre-entered, that is audit fees and insurance. And remember, we also calculated, if you go to the additional information there, we also calculated there the disposal, and we calculated, we found a loss on disposal. So we have got a loss on disposal also that is there, which is an expense. So let's go and input that one, loss on disposal. We have a loss on disposal. And the loss on disposal, we calculated it in the previous calculations. Let's go back, find the figure there. Right, the loss on disposal in the figure that we calculated here, which is 53,760. 53,760. So that's the figure that we have. 53,760. 760. Right. We go back again to check any other expense. Remember, also calculated depreciation. We already calculated it there. Depreciation, we can enter it again and go back to check the figure that we found for depreciation here. It's here on 1.1.2. calculate depreciation for equipment, and then we calculate depreciation for vehicles. We added the two, we got 221,360. 221,360. 221,360. So those are the ones that we calculated on the previous questions. So we go back to the list of balances now and try to find out what we have in the question. We can start from the start there, find out what we have there. Right. We can start from the where it's starting. Vehicles go down. Check where we have an expense. Provision for bad debts, we have already adjusted for that under the income. Go back. Go down to check another expense. We've got salaries and wages. In salaries and wages, the figure that we are given is 982,290. But we have to check in the additional information if you've got anything that is affecting these salaries and wages. If you don't have, we are going to put this 982,290 as it is. So we go down to the list of balances, find anything to do with salaries and wages. As we are seeing, we don't have anything on this page. We go to the next page, try to find out. Right, on item 7, we are being told that extract. We are being told there that, let's try to see. Right, we are being told that extract from the salaries journal for February 2023. This beneath that we are given the total for gross salaries was not posted to the general ledger. All the relevant payments of salaries were made. So this was not posted. So it means it's not there in the figure for salaries. So what are we supposed to do? Remember, the figure for salaries that we put in the salaries, that the total figure that we have there is the gross salary. Is the gross salary. And remember, the formula for gross salary, is equals to net salary, and then we add deductions. That's the formula for gross salary. So our net salary is 47,330. Then we add our deductions, which is 15,600. So the contributions that we have here is inside these deductions. So we are not going to add 7,550 of contributions. And remember, these contributions, according to the table that we are given, these contributions are for this employee. And it's inside, the contributions is inside in the deductions. So we are just going to say net salary plus deductions. So this is the information that is not included in the salaries and wages that we are having. So we are going to say the amount that we are given in the list of balances, we add 47,330 and also add the deductions of 15,600. So we can go back to recheck the total for salaries that we are given. Right, if you go up there, we check the total for salaries that we are given in the question. Salaries and wages is here 982,290. 982,290. So we come here, again. So if you add these two, you can put it as you can add it as a total after adding this one, 47,330 plus 15,600. You are going to get 62,930. So that's the figure that we are going to add for salaries. And then we go there. Now we summarize that that working. We have salaries. So here we have got salaries. Salaries and wages. Salaries and wages. Remember, we are saying the figure that we are given in the list of balances for salaries and wages is 982,290. Then we add the total that we got for gross salary, which is 62,930. 62,930. So if you do that, the total that we get there, it's 1 million, 1 million and 45,000, 1,045,220. So that's the total that we have. We go back again to check another expense that we have in the question. So after salaries and wages, we've got employers' contributions, and remember the contribution that we had for additional information was for the employee, not the employer. So we are just going to take this one, 63,620 for employers' contribution. Right. Then we have employers' contribution. Employers' contributions, the figure that we have there is 63,620. Right. We go back again to check an expense after that employer's contribution. After employer's contribution, we've got director's fees. We go again in the additional information to check any thing to do with the director's fees. And if we go to number 8, there's something to do with director's fees. They are saying the company had 5 directors until one resigned on 30 June 2022. The one who resigned was only replaced on 1 October 2022. All directors are on the same fee structure. The fees for 2 directors for February 2023 are still outstanding. So what is key there is that we have got an outstanding fee that is there for 2 directors for 1 month, that is for February month. So we have got 2 months that are not paid. 2 months are not paid. So we need to know how many months were paid. And the months that were paid will be equal to the figure that we are given. Remember, the figure that we are given in the list of balances is the figure of the actual amount that was paid. So what is important here is that we've got 5 directors, but out of these 5 directors, 4 of them were paid. 4 of them were paid for the 12 months. So we're saying 4 times. We've got 4 times 12 that was supposed to be paid. 4 times 12, and then we get 48. We get 48 for the 4 directors. Then one of the directors now resigned on 30 June 2022. So let's count how many months until 30 June until that director resigned. Remember, the year is starting in March, so we're saying March, April, May, June. So it means this director was there for 4 months. And then this director was replaced on 1 October. So from 1 October, there was someone who was being paid again. So we have got from October, November, December, January, February. So if you add this one, 1, 2, 3, 4, 5, you are going to get 5. So we add 5. So these were the months that were supposed to be paid. But they were not paid all because they are saying 2 directors for February 2023 are still outstanding, which we have got 2 months that are still outstanding that are not paid. So we subtract those 2 months to get the months that were paid. So we say 48 plus 4, we get 52, 52 plus 5, we get 57. 57 minus 2, we get 55. So we got 55 that were paid. So the amount that we have in the list of balance is for 55 months. So we want to find the monthly fee for those directors. So this 1,925,000 is for 55 months. 55 months. So we say 1,925,000 divided by 55. Let's try to calculate that one. Let's try to calculate that one. You get 35,000. So, but remember, they are saying there are 2 months that are still owing. So if every month is supposed to be 35,000, but 2 months are owing, we multiply by 2 to get for those 2 months that are owing, to get 70,000. So remember, when it's an expense, it's owing, we add that amount. So we are going to add this 70,000 to 1,925 in the answer book for director's fees. So we go to the answer book. So we say director's fees here, director's fees. So we just summarize the working that we have there. For director's fees, we are going to say 1,925,000. Then we add the 70,000 that was owing. So if we add there, we are supposed to get 1,995. 1,995,000. Right. That is what you have on director's fees. We go back again to check what other expense do we have there. So after director's fees, we go back to the list of balances to check there. We have got rent income is an income. We have got also bad debts. But for the bad debts, we have something to do with bad debts in the additional information. Remember, in the bad debt, we've got item. Let's go down. Item 4. They're saying an amount of 3,230, which was not received from the insolvent instead of a debtor must be written off as e-recovery. So it means this amount is going to be a bad debt. So it's going to increase the amount of bad debts that you are given there. 3,230 is going to increase the amount of bad debts that we are given in the list of balances. We have got 15,000 here, 15,090 plus 3,000 plus 3,230. So we're going to summarize that again in the answer section. So here we've got bad debts. For bad debts, we are going to say 15,000. Then we add the 3,230. So if you add the 2, you get 18,320. 18,320. So that is what we have. We try to find out again if we have got any other expense that is there. If you go on the additional information here, here we're given this with right. We go to the list of balances to find out what we have also. Right, we have the last one, which is sundry expenses, and it's there's a question mark, and this in brackets is balancing figure. So we are going to find this one as a balancing figure. So this is going to be our last expense that we have, and we are going to leave it blank because it's going to be a balancing figure. We'll find it later. Right, sundry expenses. Sundry expenses. And we leave it blank there. Sorry, the sundry expenses is already entered there. So no need to write it here. We have a sundry expenses here. So we put the balancing figure there. So that is what we have in terms of expenses. So we leave it. So if we don't have the total for operating expenses, it means we cannot find the total. We cannot find the figure for operating profit. We are going to leave also operating profit as it is. And then interest income is pre-entered. We go down. Now. We've got profit before interest expense. We cannot find it again. We go down. We've got net profit before tax. net profit before tax. Okay, after profit before interest, here we are supposed to have interest expense. Here we are supposed to have interest expense, and we can go back to find out how we can we find the figure for interest. We put something to do with interest in the additional information. If you come here, we have got a balance at the beginning of the financial year, and then we've got interest capitalized, repayments including interest balance at the end of the year. So that's how we can find the interest that we can put there. So the interest capitalized is the figure that we want to find here. That is the interest that we are going to put there. So if we are given these balances, so the formula to find that interest is that balance, opening balance of interest. If we add interest capitalized, and then we subtract repayments, we get the closing balance. So it's just a matter of making interest capitalized at the start of the formula here, so that we get the figure for interest. So if you make interest capitalized at the start of the formula here, we are going to say this one is going to come here, change sign, becoming a positive. This one will come here, becomes a negative. So we're going to say closing balance, we add repayments, and then we subtract opening balance. So basically, that's what we are going to do there, find that figure. So from the figures that we have there, we have got our closing balance. It's 1,125,000. We add repayments, which is 1,260,000. Then we subtract the opening balance, which is 2,205,500. So if you do that correctly, let's try to calculate that one. Let's try to calculate that one. Right, if you do that correctly, you are supposed to get 179,500. So you can just summarize that working in the answer book. For interest, so for interest here, we are saying it's let's try to just summarize the figure. The formula that we wrote there is 1,260,000. 1,260,000. Then we add the repayments, which is 1,125,000. Then we subtract the opening balance, which was 2,205,500. So by doing this, by this calculation, we got 179,500. Remember, this is an expense, so we are subtracting. But our net profit before tax, we don't have it yet. So we go back to the question again to find something to do with the income tax. Something to do with the income tax. If you go there, right? Item, we come here. Income tax for the year was calculated as 240,040. This is 30% of the net profit. So it's 242,040 and it's 30%. 242,040 and it's 30%. So we come here. So what does it mean here? Net profit before tax is the one which is 100%. And income tax we are given is 30%. So our net profit after tax, because here we are subtracting, our net profit after tax is 100 minus 30, which is what? 70. So we just make a proportion here. Was what we are saying that we are given the 30%, so we are saying 30 is equals to 242,040. Then the figure that we want here is net profit before tax, which is 100. That is the question mark. So here, that's the section that we have all the figures. So the figure that we want here is a bigger figure. So the bigger figure, this side will become a what? A numerator. And then the other one become a denominator. Then you multiply by the given figure, which is 242,040 over 1. So if you do that for net profit before tax, you can just maybe summarize it here and say 100 over 30, and then you multiply by 242 and 40 over 1. So if you calculate that one, it will become 806,800. Oh, sorry, we are not supposed to put, this is profit. Oh, sorry, this is profit before interest. This is profit before interest. It's the wrong column, sorry. Let's put it in the right column, which is here. We are going to put it here in the right column. We are going to say 100 over 30 times 2, 42, and 40 over 1. And then if you do that, you get 806,800. So if you have done this, it becomes simple now to get net profit after tax. You can just say this one minus this one, and then you get the net profit after tax. Or use proportion again. Remember, we're saying it's 70. So you can just say 70 over 30 times 242 and 40. But you always get the same figure. Here, we can, if you subtract the two, you're supposed to get net profit after tax, which is 564,760. So that's what we have. So we can now go up there and try to find out the figures that are missing there. So we are now here. We want now profit before interest. So to find this one, we said this one minus this one to get this one. So to get this one, we are now saying this one plus this one, then we get profit before interest, which is now, if you add the two, you get 986,300. Right. Then we now want to find this one. So to find this one, we said this one plus this one. Then we found this one. So to find this one, now we are saying this one minus this one. Then we get this one. So if you do that, to say 986,300 minus is it 120,000, you get 866,300. Right. So we go up. We've got a missing figure again. Missing figures on top there. So we go up again. If we go up here to find operating profit there, we said this one minus this one to get this one. So to get this one again, gross operating income, we're going to say operating profit plus to get operating profit, we said this one, which is 4,613,150 minus this one, so that we get this operating profit. So to get this one again, we find the difference between the two. We find the difference between the two. So if you find the difference between the two, you are supposed to get 3 million. Yeah. So let's just maybe try to put the formula there. Remember, operating profit, we found it as 866,300. Then we subtract the 4. We got it as 866,300. Then we subtract the figure that we have there. We subtract it from, we can just put it here, 4,618,150 for gross operating income. 4613 150. Then you subtract 866,300, then you get the figure for operating expenses. So if you do that here, the figure for operating expenses will be 3,746,850. So that's the figure that we are going to put here. 3,746,800 850. So this one is a negative figure. So we still have the figure for sundry expenses that we want to find, remember. So you are going to add the total for all the figures that you are having under operating expenses. You are adding this one plus 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 this one. Then you subtract the total from the total for operating expenses, which is 3,746,850. So if you do that, the figure, then you get the figure for sundry expenses there. So the figure for sundry expenses there, if you calculate correctly, you get 112,590. 112,590. So this is the figure that you get there. So this marks the end of our statement of comprehensive income, or the income statement. So we are left with the other section, which is the other section here. We want the extract of financial position. So that's where we are now. Let's try to find out how we can finish this one. Right, we are already given the figure for ordinary shareholders' equity is 5,870,750. Then the figure for retained income again, for retained earnings, is given again in the question. Let's try to go to the list of balances that we have. If you go to the list of balances that we have, we are seeing that retained income is given there. Retained income here is 970,750. So we can go and input that one, 970,750 for retained income. So we have retained income there. Ordinary equity. So we have ordinary share capital. But the figure for ordinary share capital is not given in the question. And then we've got retained income. And the figure for retained income is the one that we are given, is 970,750. 970,750. So we can now find the figure for ordinary share capital by saying 5,870,750 minus this one. Then we get for ordinary share capital now, we get 4,900,000. Right. So then for non-current liabilities, we've got a mortgage loan that we have. Right. We go back to find out the figure for mortgage loan in the list of balances in the question. Right. For mortgage loan, we have this figure. Let's go back. There is a question mark in the list of balances, but we have information that we are given in the additional information here. Here it means this is the balance that we have, 1,125,000. 1,125,000. This is the closing balance of the mortgage. But then we have got additional information that we are given there. We've got additional information that we are given there. Let's try to see our additional information. Right, additional information is saying the loan balance will be reduced by 625,000 in the next financial year. So what does it mean? It means this 625,000 is the current portion of loan. So we are going to remove this one from the balance that we have for mortgage, and then this one will transfer it under current liabilities as a current portion of loan. So we are going to say 1,125,000 minus 625,000. for the balance for mortgage loan. So we go there and summarize that working. Right. So for mortgage loan, we can just summarize the working and say 1 million 125,000. You can say 1,125,000. Then we are subtracting 625,000. 625,000. So if you calculate it very correctly there, you get 500,000. Here it's now 500,000. And this becomes the total for non-current liabilities, 500,000. Then we go to current liabilities now. Right. On current liabilities, obviously, we can start with trade and other payables. For trade and other payables, we are going to say the figure for trade creditors control or trade payables that we are given in the list of balances. Then we try to find other payables that are there in the question. Right. We go to the list of balances and try to find the figure for creditors control. Right. Creditors control, we have 448,725. So we are going to enter that one, 448,725 in the working parts. Right. We say for creditors control, 448,725. And then we try to find for other payables like accruals for expenses we put there, and then prepayments for income. So remember, we've got a prepayment for income that we have that we subtracted there for rent income, 14,025. It's a prepayment for income. So when an income has got a prepayment, it's a current liability. It's opposite to an expense. Expense, when we have a prepayment, it's a current asset. But for income, when we have a prepayment, it's a current liability. So 14,025, we add it again there. That's another payable that we have, 14,025 plus 14,25. Then we also have an accrual of an expense. An accrual of an expense. Let's try to find out there under operating expenses. Director's fees, remember 70,000 was in accrual. There were 2 months that were not paid. So we also add that 70,000. It's also a payable accrual of an expense. Add 70,000 there. And also, if you go to the when we disposed we had acquired also a non-current asset or purchased a non-current asset. Remember here, we an old vehicle with cost price, and then if you come here, was traded in. You come here was traded in on 28th February 2023 for a newer model which costs 616,500. But this amount, we are supposed to pay this amount because we are purchasing this newer model for 616,500. But we traded in with a value of what? Of an old vehicle of value of 105. So it means this value is going to reduce the amount that we are supposed to pay. We are supposed to pay 616,500, but we traded in with a value of 105. So it's going to reduce the value that we are going to pay. So if we subtract these two, you get the balance that we are supposed to pay. But in the question here, in the information that we have, we are not told whether we paid or not. So the assumption is that we did not pay anything. So we are still owing something, and it becomes a payable. So if we say 616,500 minus 105,000, you are supposed to get 511,500. So this amount, again, we are going to add it for other payables. 511,500. 511,500. So that's what we have there. That marks the end of our payables. Then we are supposed to add there. So when we add those ones, that is trade and other payables, we are supposed to get 1,044,000. 1,044,250. Right. So that's what we have. And the next item that we have, you also have current portion of loan. Remember that current portion that was transferred from mortgage. This one 625,000. It's supposed to come here as current portion of loan. Then also we are supposed also to have let's go to the issue of tax. Was on tax side that it might be a prepayment or an accrual of tax. We might have a prepayment or an accrual of tax. So to find out whether it's a prepayment or accrual, we go to the provisional payment of tax that was made. The provisional tax payment that was made during the year. The provisional tax payment that was made was 196,040. So we paid 196,040, and then we compare with the actual tax amount. If the actual tax amount is greater than this provisional, it becomes an accrual and we put it under current liabilities. But if the actual amount is less than the provisional, it becomes a prepayment, then the difference we put it under current assets. So 196,040, then we check the actual tax amount that we have. We are told the actual is 242, so it's greater. So this one becomes a current liability. So we can just say SARS income tax. SARS income tax here. We have SARS. This is income tax. SARS income tax. So in brackets, we just calculate. We just show the working there. The actual tax was 2,242,040. Then you subtract the provisional that was made, which was 196 and 196,040. So if you subtract the two, you get 46,000. So this is the difference that we have. And we still have also shareholders for dividends. Remember, on shareholders for dividends, remember the final dividend is always carried the next period as an accrual because it's declared at the end of the financial year. That is so there's no way that this final dividend can be paid. It's always carried to the next financial year as a what? As a current liability. So let's try to find out in the information that we are given in terms of these dividends at the end of the question. We are told that the total dividend for the year amounted to 410,000, which includes an interim of 160. So we need final. Remember, interim plus final is equal to total dividends. So here, the one that we need to say is here final. So final, we are going to say is equal to final is equal to total minus interim. So our total we are given is 410. And then we subtract our interim, which is 160,000. So if you do that, you get 250. So you are just going to summarize that working 210 minus 160. So here we come here. Shareholders for dividends, it's 410 minus 160. So if you calculate that, you get 250,000. Right. Now we add the total for the current liability. So add this one plus this one plus this one plus this one. You get 1,044,000. 1,965,250. Then obviously now we are now adding the figures that we have there for the shareholders equity, which is 5,870,750. We add current liabilities, which is 1,965,250 plus non-current liabilities, which is 500,000. To get the total for the second balancing figure for a normal statement of financial position there. So the total that we are supposed to get there, the total, let's try to find out on the total that we are supposed to get there. For total equity and liabilities, it's supposed to be 8,336,000. Right, so that is what we have, guys, for the question in June 2023. On question 1, that is all what we had. Thank you for listening. Please keep in touch. Those who haven't subscribed, please support the channel by subscribing. We are still in touch. With that, I'm out.